Welcome to the deep dive. This is where we take the raw data, the company reports, all the sources, and really try to figure out what's going on. Today, we're looking at Mold-Tek Packaging Ltd, MTPL. They're a big name in India's rigid plastic packaging industry. I've got their latest results here, Q2 and the first half, H1 of FY26. And here's the puzzle we're trying to solve. You look at the first half, H1, and revenue's up a solid 16%. Looks great, but then zoom into just Q2 and volume growth, it slows right down to 7%. So what's causing that? And maybe more importantly, why is management so focused on the pharma sector now? They seem to think it's the next big profit engine.
It's a really interesting story of a company shifting its strategy. MTPL isn't new. They've been around since '86, listed since '93. What really sets them apart is their tech. They were the pioneers in India for something called in-mold labeling, IML. And this IML, well, it's kind of their superpower. It means they can do these high-quality photographic labels molded right into the plastic. Plus, it's totally hands-free, super hygienic production, which is obviously a huge plus when you're dealing with big players like Asian Paints, Castrol, Shell, or food giants like HUL and Mondelez. And they also talk a lot about backward integration, controlling more of their own supply chain, which they say gives them, well, better margins than the competition.
Okay, so let's dig into those numbers. Maybe start with the half-year H1 because, like you said, those results look pretty strong overall.
Right. So H1 FY26 compared to the same period last year, H1 FY25, revenue grew 16%. Came in at INR 450.32 crores.
16%, okay. And profits.
Followed right along. EBITDA, that's earnings before interest, taxes, depreciation, and amortization. It jumped 23% to INR 86.88 crores.
23%.
Wow. And net profit after tax, PAT, also up strongly, 24% growth, hit INR 37.88 crores.
Okay, so strong top and bottom line growth for the half year. What about volume? How many tons did they actually ship?
For the full 6 months, volume was up 11%. That works out to 21,396 metric tons.
Got it. So volume up 11%, but EBITDA up 23%. That gap is interesting.
Exactly. That's the key takeaway from H1. The fact that profitability grew so much faster than volume tells you they're getting more value out of each unit they sell. Which brings us to that efficiency metric you mentioned, EBITDA per kilogram. That's really the number to watch here.
And where did that land for H1?
It grew 11% year-on-year for the half, hitting INR 40.61 per kilo.
40 rupees, 61 paise per kilo.
Yeah. And that increase, it's not just random. It's clearly showing that shift in their product mix that management keeps talking about. They're selling more valuable stuff.
Okay, so H1 looks pretty good. But now let's get to Q2, because that's where things got a bit, well, slower, right?
All right. Management did flag that Q2 and Q3 are usually their weaker seasons, but yeah, the slowdown was noticeable.
So Q2 FY26 versus Q2 last year, revenue was up 10%, which is still decent, INR 209.76 crores.
But volume growth, that dropped to just 7%, 10,019 metric tons. And yeah, 7% volume growth does feel a bit soft compared to the H1 trend.
It really does, especially for a company pushing for growth.
And there was actually a bit of confusion around the Q2 profit numbers initially, wasn't there?
Oh, yeah, that's right. Tell us about that.
Well, the first press release that came out reported Q2 EBITDA growth at only 4.52%, which, with 7% volume growth would have looked like margins were getting squeezed quite badly.
That would have been worrying.
Definitely. But they quickly corrected it. The actual revised number for EBITDA growth was 15.74%. So EBITDA hit INR 39.56, much healthier.
Okay, so nearly 16% EBITDA growth on 7% volume growth. That changes the picture quite a bit. It means margins actually improved in Q2 despite the lower volume.
Precisely. Even though their overall capacity utilization dipped quite a bit, it went from about 74% in Q1 down to just 63% in Q2.
63%, okay.
They still managed to protect and even slightly expand their margins per kilo.
So they sold less stuff overall, but the stuff they sold was more profitable.
That's the core story here. Trading lower margin tons for higher value products, that 7% volume number looks weak on the surface, but the nearly 16% EBITDA jump, that signals the strategic pivot is working.
Okay, so let's unpack that mix change. We need to look at the different business segments. There are 4 main ones, right?
Yeah, paints, lubes, food and FMCG, and the new pharma division. And performance varies quite a bit between them, especially in Q2.
So where's the real momentum coming from? Which one is the standout?
No question, it's pharma packaging. This seems to be where they see a huge chunk of their future margin growth.
The numbers look pretty dramatic there.
They really do. Sales in pharma grew, get this, 45% just in Q2 compared to Q1. So quarter-on-quarter growth.
45% in 3 months. Wow. What does that look like in rupees?
It jumped from about INR 7.4 crores in Q1 to nearly INR 11 crores, 10.81 crores in Q2.
And management sees this as the key driver going forward.
Absolutely. They're already hitting over 50% capacity utilization in pharma after just their first year of operation. That's a pretty fast ramp up.
What kind of products are we talking about in pharma?
It's things like EV tubes and stoppers, particularly for the nutraceuticals market.
Mm.
They've also developed something like 40 different types of bottles and caps. Canisters are just starting to pick up steam now, too.
Oh, okay. But why is pharma so much more profitable? You mentioned that EBITDA per kilo metric earlier. The company averages around 40. Where does pharma sit?
Well, the estimates put pharma's EBITDA per kilo somewhere between 100 and 120 rupees, conservatively.
100 to 120. That's like triple the average.
Exactly. And the reason they can command that kind of premium goes back to that IML technology. Remember the hygienic, hands-free production?
Right. Crucial for pharmaceuticals.
Absolutely crucial. Contamination risk, regulatory compliance. These are huge deals in pharma. MTPL's process basically minimizes those risks so they can charge a premium that, frankly, lower-tech competitors just can't justify. That's their moat.
Okay, so pharma is the clear growth and margin star. What about the other segments? Food and FMCG? That includes their QPAC division too, right?
Yeah, and that segment actually showed a pretty good comeback. Volume growth there was strong in Q2, up 19.55% compared to Q2 last year. Double-digit growth.
19.5%. That's solid, especially given the season.
Right. Management said diversifying into products that aren't so seasonal really helped them here, because the heavy rains apparently hit demand for things like ice cream tubs and yogurt containers quite hard.
6 cents.
But their specialized QPAC division, which does more high-end stuff, actually had its best quarter ever in Q2. That helped pull the whole food and FMCG segment up stuff. QPAC volume jumped over 20%. So good resilience there.
Okay, so pharma flying, food and FMCG resilient. That leaves paints and lubes. And this must be where the Q2 volume slowdown really hit.
Exactly. This is where the monsoon effect really bit hard. Let's take paints first.
How did paints do in Q2?
Volume growth was really muted, only 3.36% year-on-year. And remember, in Q1, paints volume was growing over 20%. So that's a steep drop.
Wow, just 3%. Why such a big fall?
Management blamed it squarely on the heavy, persistent monsoon rains. Not just in India, but globally, apparently. It just stopped people from painting. Simple as that.
Okay, but wasn't there a specific point about one large customer, Gressam?
Good point.
Yeah.
Yes. Their business with Grasm Industries, which is part of Aditya Birla Group, actually grew well. They saw something like 17 to 20% value growth with Grasm in Q2.
So how does that square with the overall 3% volume growth for paints?
Because they had recently boosted capacity specifically for Grazine, so they were gaining share there. But that gain was basically wiped out because volumes from their other big paint customers, like Asian Paints, were apparently flat or maybe even slightly down because of the rain.
Got it. So even strong performance with one client couldn't beat the weather across the whole segment.
Pretty much. And the lube segment, that fared even worse.
Worse than 3% growth.
Oh, yeah. Lubes actually registered negative volume growth, down 13.45% in Q2 compared to last year.
Minus 13%. Why so bad?
Well, again, the monsoon played a part. Slowdown in goods movement, trucks not running as much, impacts lubricant demand. But management also hinted at maybe a longer-term structural thing here, too. Modern engines just keep getting more fuel efficient, better mileage per liter. That could mean lubricant consumption growth might just naturally lag over time.
Interesting. So pulling back from lubes might actually be a smart long-term move, not just a reaction to a bad monsoon season.
Seems like it could be, yeah. So the overall picture for Q2 really becomes clear when you look segment by segment. They're deliberately shifting away from those weather-sensitive, maybe lower-margin segments like lubes and parts of paints.
And pushing hard into pharma and the more resilient, diversified food and FMCG areas.
Yes, exactly. Trading volume for value.
Okay, so this strategic shift seems to be working, at least in terms of profitability. But how are they making sure this continues? What are the sort of operational steps they're taking to support this growth, especially in pharma and food?
Right, because you need the capacity and the reach to make it happen. And they are definitely investing. A big one is geographic expansion. Look at the new facility they've set up in Panipat in North India. That's a major move.
Panipat, when does that come online?
It's set to start contributing from Q3 onwards, so pretty much now. This is huge for strengthening their position in the North, especially for food and FMCG customers.
Closer to the big markets there?
Exactly. They've apparently already signed contracts with dairies in the Delhi NCR region, so they're aiming to fill that capacity quickly.
And didn't they also do some capacity upgrades recently?
Yeah, they completed enhancements at their Chayar and Panipat plants specifically to meet the growing demand from Grasim Industries, that paint client we mentioned.
Okay. And what about supporting that big pharma push long term?
Well, they just made a significant land acquisition. They bought 2.5 acres right next to their existing Sultanpur unit.
And that's earmarked for pharma.
Yep, specifically for future pharma expansion. They're planning it in phases, but the ultimate goal is to build capacity up to 2,500 tons per annum there.
2,500 tons just for pharma. What kind of revenue could that generate?
They estimate that at peak capacity, that could bring in somewhere around 85 to 90 crore rupees in revenue. So it shows a really serious long-term commitment to making pharma a core pillar of the business.
Okay, so capacity is expanding. What about the technology side? Are they still leaning heavily on that IML advantage?
Oh, absolutely. They're actually doubling down on it. They're working on introducing what they call next-generation IML printing tech.
Next-gen IML. What does that mean practically? Better looking labels.
Maybe, but the real focus seems to be on cost and flexibility. They're targeting a 7 to 10% reduction in the cost of consumables used in the IML process.
7 to 10%. How much does that save per kilo?
They estimate it could be around 1 rupee per kilogram benefit, which, might not sound huge, but it goes straight to the bottom line and helps them maintain that 40-plus EBITDA per kilo target.
Makes sense. Any other benefits from this new tech?
Yeah, a really important one. It allows for lower minimum order quantities, MOQs.
Ah, so they can serve smaller customers.
Exactly. More flexibility. It could open doors to maybe smaller, faster-growing brands, especially in FMCG or even niche pharma areas that they couldn't really cater to efficiently before. Big competitive advantage.
And they do a lot of this design work in-house, right?
They do. They have this setup called the D3 Suite. It's their design studio and tool room. Apparently, they've launched over 200 concepts from there, won awards, and even hold patents on product designs and how they build the molds.
So that ability to innovate quickly and create custom solutions must be key, especially for winning those high-value pharma deals you mentioned.
Definitely ties in. Okay, so putting it all together, what's the outlook? What are they guiding for the rest of the year?
Well, volume-wise, they're suggesting Q3 might look pretty similar to Q2, still feeling some seasonal effects, plus they mentioned a bit of a lull in customer pickups in September right after a GST announcement.
Okay, so maybe not an immediate bounce back in Q3 volume.
Seems like it. But the forecast is for a strong Q4. They expect a return to double-digit volume growth then.
And what's driving that Q4 pickup?
Two main things. The new Panipat facility really starting to ramp up production, and secondly, new molds for the pharma business becoming fully productive and churning out volume.
Got it. So despite the Q2, Q3 softness, they're sticking to their full-year volume target.
Yes, they're maintaining the guidance for 10 to 12% volume growth for the full fiscal year.
Okay, and profitability, that crucial EBITDA per kilo number.
They sound very confident about that. Confident they can keep it at 40-plus rupees per kilo in the second half of the year.
Which, remember, is a big step up from last year's average of around 37.6.
Right. And that confidence comes back entirely to that product mix shift we've been talking about, more pharma, more specialized food, plus those IML efficiency gains kicking in.
And did they mention anything else on the regulatory front, like that GST point?
Yeah, interestingly, while the initial announcement might have caused a brief pause, they noted some later regulatory changes, I think related to GST rate cuts on ready-to-eat products, are actually expected to boost demand for packaging in that food segment going forward. So maybe a bit of a tailwind there eventually. #tag outro.
Okay, so let's try and wrap this up. What's the main takeaway here? It feels like the story of MTPL right now is about successfully managing through a typically slow season.
Right, dealing with the monsoon, a bit of GST uncertainty, but doing it by really hitting the accelerator on those high-margin specialized segments. Pharma is the obvious star, but also that resilient performance in food and FMCG.
Yeah, it's like they've proven they can pivot the business model. They seem willing to sacrifice some pure volume, some metric tonnage, if it means boosting the overall profitability and focusing on those areas where they have that technological edge.
So if you connect that to the bigger picture, All the investments they're making.
Exactly. The new Panapat plant, the IML upgrades we talked about, buying land for massive pharma expansion. It makes that short-term 7% Q2 volume number seem, well, almost less important.
Yeah, the real story is maybe the nearly 16% jump in Q2 EBITDA value and the potential for more.
Right. It feels like they're using this period not just to weather a storm, but to fundamentally reposition the company towards higher value products. It changes how you might think about their valuation going forward.
Okay, so here's a final thought for you, the listener, to mull over. We heard that pharma EBITDA per kilo is running around 100 rupees, maybe even more. The company is aiming for 10-12% volume growth this year overall. So, thinking ahead as that big new pharma capacity they're planning comes online and the North India facility fully ramps up next year, how much further could that strategic shift push the overall company margin? Could it go significantly beyond the 40 plus level they're targeting now? Something to think about.